Hello, my friends. Brett Pattison here with Iron Gate Global Advisors. I am a portfolio manager and investment advisor here at Iron Gate Global Advisors, and I thank you for spending a few minutes with us on our March market commentary, where we will answer the question you see right before you: will spring be kind to investors? We'll also talk about a few other things. In fact, let's take a look at our agenda for today. We will address the question, or really address first and foremost, as we always do, we'll look at the prior month, in this case February. We'll see what was hot and what was not in February, and then we'll see what was hot and what's not year to date as far as global and sector returns. Then we'll talk about the foreign markets. We're seeing something very interesting from the foreign markets and whether they're gaining strength or not, and we'll answer that question. And then we'll address the one that we've already talked about, and that is, will spring be kind to investors? Now, I've got to say up front that nobody knows exactly what the market's going to do. We're going to talk a lot about history. We are probability investors here at Iron Gate Global Advisors, and part of those probabilities and giving you an edge, so to speak, is understanding what usually happens historically. And when we put it in those terms, it gives us an opportunity to essentially invest with the probabilities on your side. And so moving forward, the month of February was actually a really good month, not only in our all-cap value portfolio, which I'm not even going to get into. Clients have access to that, but also in the global markets, and that's what I'll share with you. January was a really scary month for most people. We addressed it in our market commentary. February, we answered the question, will the bull market continue, or what we believe is our analysis on whether the bull market will continue. And in February, again, great month. Reminds me of this skier flying through the air, right? I mean, it was that kind of month. And of course, back east, our friends have that much snow, as you can see on the picture. So good luck if you live back east. All right, so let's take a look at the February global markets. And the S&P 500, which is the United States of America, the good old US of A, was up 3.43% in February. The developed non-US markets actually led the globe. They were up 3.56%, and the emerging markets were 0.4%. Now, I just want to make sure we're all on the same page in understanding what these global markets are. The developed non-US, those are the countries of European countries. It's Japan, it's Australia. They're developed, of course, non-US countries. The emerging markets would include China, India, Brazil, Russia. They're those countries. And so you can see how those areas of the globe did. Now, as far as 2015 year-to-date returns, the U.S. is up 3.13%. The bull market is continuing, as we addressed last month. The developed non-U.S. has been, it's been doing very, very well. And keep in mind, the developed non-U.S. and the emerging markets have lagged the U.S. for years now. And we're starting to see maybe some rotation, some market rotation and money going into these cheaper areas of the globe, like the developed non-U.S. and like the emerging markets. Will that continue? Nobody knows for sure, but year to date, they're performing very, very well. In fact, let's take a look at a quick chart of the VEA. This is a Vanguard ETF that tracks the developed non-U.S. markets. And you can see back in September, October of last year, the markets really were hit hard. Bad news coming out of Europe. In fact, there's been no good news coming out of Europe still. And actually, we like that. If you think about the news that we've had in Europe, you've had Greece. You've seen Greece on fire, let alone hear about Greece on fire. We've seen terrorism, which is horrible, coming out of Europe. We've seen a lot of growth trends, and even in some countries, some negative interest rate returns as far as their debt goes. It's been not a ton of good news coming out of some of these countries. However, they're cheap and they have momentum on their side. They've got a PE ratio that's about 4 points less than the U.S. right now. So they're cheaper than the U.S., and we're starting to see some momentum come into these areas of the globe. Our clients will understand as they look at their portfolio how we're managing that. And of course, if you're not a client, you can look at that and manage how you see best fit for your portfolio. But we're definitely seeing momentum there. As far as the emerging markets, I apologize for this screen not being the most attractive snapshot you've seen, but nonetheless, it gives us a good idea of what's happening in the emerging markets, which is what I want to do. This is a 6-month chart of the emerging markets. You can see this black line. There's all sorts of different countries, and I'll point out a few of them, but the black line, the middle line, is an ETF called the EEM. That's an ETF that tracks the emerging markets. We're down for really since August of last year. We're down. Now, however, we've seen 3 countries that have been doing pretty well. In fact, 2 countries that have been doing fantastic. And that is China, which is up slightly over 7.5%, and India, which is up over 5%, right? Closer to 6%. Those 2 countries have been performing very well. And China being the cheaper of the 2 on a valuation perspective, but both showing some great strength. And if you think about the news as well, coming out of these areas of the globe, and it's not great, but we're starting to see some great performance from those areas of the globe. Of course, you have 2 countries that are just that might be literally on fire, and that is number 1, Russia, which has been hammered, which is, I'll just say it's a mess. And then Brazil, which you've seen some state-run companies which make up a large portion of that country, namely Petrobras, just getting hammered, which has had a horrible effect upon that market. They're lagging. China and India are leading. That takes us domestically into the domestic sectors. And as we look at these, there's a couple things I want to note. Each month, we talk about and look at these sectors. However, in October, November, we mentioned a couple sectors specifically. We talked about consumer discretionary and industrials. And we talked about those 2 sectors because typically during this time of the year, they generally outperform the market. And we're seeing that right now, especially from consumer discretionary. That's been leading in February. It was up 6.38%. All right. Defensive names, defensive sectors like staples, like utilities generally underperform the market. And you can see that utilities has been land blasted, and that's a lot to do with interest rates and how sensitive they are to interest rates. But you've seen not only consumer discretionary outperform in February, but you've seen it outperform year to date. It's up 7.11%. We talked about it back in October, November. Even the last couple months, we've talked about consumer discretionary and the possibility of being overweight consumer discretionary, and it's worked. That's putting the probabilities on your side. We also know that utilities is lagging the market. Industrials, which typically outperforms, you can see is up 2.9% in February, 2.53% year to date, and they've been hit a little bit more because of oil and the impact that oil and the price of oil has had on that specific sector. Not performing as it usually does, but we still have a couple good months ahead of us that perhaps it may come back. And I want to say this as well. We talk about these historical trends of the market. On our website, on the education tab, so that's igga.com, on our education tab, and I'll even show you where that is a little bit later in just a minute. There's videos on what we're talking about with this market rotation and these seasonalities that I'm speaking of that can help you understand and put the probabilities on your side in terms of overweighting and underweighting your portfolio. And we've seen that with consumer discretionary. It's worked out. Industrials, to be determined, right? We've got a couple more months to go before we ride it off, but it's underperforming right now, so we were wrong there. As we look at specifically March and April, let's get into April. First off, it's St. Patrick's Day, so if you're Irish, happy St. Patrick's Day in March. All right, so let's talk about spring. And since 1950, March has the S&P 500 average March return is 1.2%. So since 1950, the S&P 500 in March is averaging a 1.2% return. March also paves the way for April. So you have March, which is about 1.2% on average historically. You've got April, which is even better than that, and we'll talk more about April next month. But March and April are 2 months that are very bullish historically. And March generally paves the way for April. The interesting thing about March that I want to share with you is it usually starts out strong or certainly as strong the first 15, 20 days, right? It's strong and then generally tapers off at the end of the month. And so as you look at March, as you're looking at your own returns and your own trading, your own investing, certainly that's what happens historically. Whether that happens this month is to be determined. But let me show you some historical, some historical looks of what I'm talking about. This is 2006. We started out strong in March and then kind of tapered off really for half of the month. 2007, we had this big boost early on, a little bit of a pullback, but then the boost, and then it tapered off, just as we mentioned in 2007. 2008 was a little different. That's when it was kind of choppy and then choppy but up, right? 2008, which was just a horrible year for most people. And then you had 2009, which again, strong start and a tapered off end to that month of March. 2010, same thing, strong start, tapered off towards the end. And so you can see by looking at history, it helps set our expectations for what happens in March. We're very excited about the next couple months because of that history. We will manage our portfolios accordingly, but we'll also manage risk. Just because that's what's happened in the past, if there's a 70% probability that something's going to happen, there's a 30% probability it's not. And so we need to set expectations in the right way. But we're excited for March. We're excited for April. We're excited about our all-cap value portfolio, which is doing fantastic. And we're excited about our global portfolios as well, which you can see the global markets are doing very well year to date. So we've looked at the last couple minutes. We've looked at February. We've looked at the year-to-date returns. We're understanding where that strength is, especially around the globe. And yes would be the answer to that question of whether or not foreign markets are gaining strength or not. And then we really did answer the question, will spring be kind to investors? At least it's our attempt at answering the question. We'll find out in a couple months whether it truly is. But based on history, I think we have a lot of reasons to be optimistic for the next couple months. Now, I also mentioned, as we round out a couple things on our website, which we're very proud of what we've created on our website and specifically on this education tab. I would urge anybody that hasn't been to that education tab to jump in, take a look at it. Our strategies are there. It's constantly being updated. We also have a blog that is constantly updated. It really provides great transparency from us to our clients or to anybody that is interested in how we view the markets. Of course, there's no specific recommendations or anything that on our public website. That's done for our clients outside of this website, right? In kind of more of a private way. But it'll give you a good feel for how we look at the market and how we build our portfolio. Now, that said, my friends, if there's any questions, feel free to give me an email. Or send me an email. That's a brett@igga.com. You can see our phone number there. Connect with me on Twitter as well and LinkedIn. Would love to, by connecting through Twitter, you can see more of an up-to-date, timely fashion of what we're thinking. Of course, nothing is recommendations as we send it out. More of our thoughts as to what's happening. And with that, I would say to all of our clients listening, thank you. You have a lot of choices out there as far as investment advisors, and you trust us. We take that very seriously. For those that are not clients, I hope you found value in what you heard. And of course, reach out to me anytime you would like. With that, have a great month of March, and we will see you in April. Thanks.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and/or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.